Okay, welcome to the July 25th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk about what happened in the soybean oil market last week and how that impacted biofuel margins, and then review the EMTS data that came out last Thursday and talk a little bit about the difference in price between soybean oil at the U.S. Gulf or in central Illinois and soybean oil from Argentina. So last week, soybean prices were up about 4.5 cents. It was all futures driven. Didn't look like the basis change for crude or RBD. And you can see that Q2 of 2023 is over. Actually, we're in Q3 now. Well, Q2 and Q3 of 2023 have erased a lot of the losses from the last couple of quarters, and prices have gone up nearly as much as they did in the first quarter of 2021, which is quite a reversal from where we've been for the last 9 months, basically, which has been prices generally falling. Concerns about the U.S. crop are certainly there and contributing to the strength in soybean oil, although strong domestic demand is also helping support soybean oil prices. And I think more and more, excuse me, even though the U.S. has really become a domestic market, I think that world veg oil supply is tightening up, in part because of what's going on in Argentina, in part because there's concerns about the U.S. crop this year. World veg oil prices have started to move a little bit higher. And I say that because, and I was talking to Joao about this earlier, when we did a webinar where we talked about palm oil, and we had this forecast that was like 3.1 million ton carryout. We said, okay, well, we don't really think it's going to be 3.1 million tons, but we do think it's going to go up substantially, and that sort of reflects a more balanced world supply and demand situation. And I think that was probably about the peak of the more balanced world supply and demand situation. And I think part of the reason that soybean oil futures have rallied so much last week was in part because of what palm oil did. There's always a little bit of chicken and the egg between palm oil and soybean oil, and palm oil typically follows soybean oil. But now that the U.S. market is so domestic, that relationship had broken a little bit, and palm oil, the spread between soybean oil and palm oil had gotten really wide. And we'll look at that again in a couple of minutes. But it does feel like the soybean oil futures are reacting a little bit more to what's going on in other vegetable oil markets than they have for a while, essentially. And so I think that that obviously the U.S. crop and weather conditions over the balance of the summer will be important. Last week, the USDA reported that soybean crop conditions fell just slightly, just by 1%. But that's, from sort of historically low levels anyway. I think we've made it back up into sort of the 5-year range, just barely. So falling down, it's not the same as sort of a 1% change if 70% of the crop is rated good or excellent, with just 55 or 54% of the crop rated good or excellent. Every percent counts. And so I think it's some combination of those concerns, and then what else is the things that are going on in the world markets. Now, all of that said, soybean oil, the spread between soybean oil and other vegetable oils has really widened over the past month or so, and we're back out towards sort of the historic highs that we've seen in the last couple of years, which are levels that honestly I wouldn't have thought that that we could get to. And one of the biggest is the difference between U.S. soybean oil at the Gulf and prices in Argentina. Now, this is really surprising because Argentina had this huge drought last year, and so we and a lot of people are expecting that Argentine production will drop, although Argentine farmers can help offset some of the production losses by selling a little bit out of their stocks. And we've talked before about how they're less concerned about price than they are about using soybeans as a hedge, but still, the price of soybean oil in Argentina would suggest that they're not really having a hard time sourcing soybeans or producing soybean oil. I suppose on some level, maybe it also is, I suppose it could reflect just sort of a sharp decline in demand for exported soybean oil. And that's what's offsetting the drop in supply. But either way, the difference between Argentine soybean oil and U.S. soybean oil at the Gulf is about like 30 cents a pound. And so what that means is that you can effectively buy soybean oil from Argentina, you can pay the tariff, and you can pay if you're a renewable diesel producer, you can pay to have the oil EPA certified so that it will generate RINs. And then you can ship it basically anywhere in the US, and you still are going to be 10 cents roughly. To do this calculation, I used the most expensive shipping that I could find for out of Argentine port. So basically the rate that Fast Markets reports for shipping from Argentina to Asia, and then 4 cents for rail in the US, which will get you should get you from Central Illinois almost out to California. So pretty much ship it anywhere in the US and probably paying a little bit less in ocean freight than we're calculating. And if you do that, you're still going to be about 10 cents ahead of soybean oil that you buy from the US Gulf. So that would suggest that we're just going to import a ton of soybean oil. So Econ 101 would say that soybean oil buyers with perfect information will know that they can buy Argentine soybean oil significantly cheaper, and they'll do that. However, the reality of it is a little bit different. And if you are a big buyer, or a small buyer really, then you have been buying soybean oil domestically, and you have a relationship with your crusher, and that relationship is worth something. And so much in the same way that we kind of talked about biodiesel producers needing to be really convinced that margins were going to stay low for a long time before they started to reduce capacity, in the same way, it's difficult for buyers to break that relationship with their crusher if they think that this is a situation that's just going to persist for a month or 2 months or whatever it is. Now, anecdotal reports last week suggested that there were a couple of cargoes out of Argentina headed for the Gulf. That's not really surprising in any year, really. I mean, we import 300 or 400 million pounds of soybeans, so a couple of cargoes here and there, that's always going to happen. But with prices where they are, you would think that ships would be lined up bow to stern from Argentina to the US Gulf. And that's just not what we're seeing, at least right now. Now, if buyers become convinced that that this is going to persist, then it might start to be worth it to start to look at importing some of this. And even when they get to that point, then it still is the whole US industry is set up to export soybean oil, not import soybean oil. And I don't mean that like we don't have the rail cars to run from the Gulf to wherever imported soybean oil would need to go. I mean it more like we have people whose jobs it is to sell US soybean oil to other countries, and that position, there's not really a similar import position. even though we import a little bit of soybean oil, there's not as many, I guess, of those positions. And so it's that part plus the relationship part that I think makes it tough and makes it so that we're not about to just raise our U.S. soybean oil import forecast by 600 million pounds or 700 million pounds or whatever, just because of the spread. Now, it may be that in the short term, we do start to hear more sort of one-off cargoes coming up from Argentina because the spread is just so absolutely wide. But in terms of a renewable diesel producer that has been in business for 3 years and has a good relationship with their crusher, shifting those purchases to South America is just more difficult because, again, when they tell their seller at the crusher, when their relationship manager at the crusher, that they're going to buy Argentine soybean oil, it's obviously not going to make them super happy. And so I don't think that while this is really important, and if it persists for a long time, I think we probably will start to see more U.S. soybean oil imports than we expect. It's not something that is going to change our supply and demand assumptions, at least in the short term, really significantly. Again, if it lasts, if it persists, and if the U.S. crop is not everything that we expect it to be right now, then maybe we'll start to ramp up our U.S. soybean oil imports. But in the short term, or until we decide to do that with the crop, we're going to stay relatively close to where we are. Here's another spread that is near the bottom of its historic range, and that's one we've talked about a lot before, and it's RBD canola oil in Los Angeles versus RBD canola or soybean oil in Central Illinois. And you can see it's at the bottom of its historical range. We really don't expect that to move that much. The relative demand for soybean oil because of the growth in renewable diesel has compressed this spread, and the recovery in canola seed and canola oil production following the drought in Canada a couple of summers ago has also contributed to the spread moving lower from the highs that we saw sort of at the end of 2021. And there's nothing really that looks like it's going to make this relationship go back to its long-term average sort of in the short term. Obviously, crop production in the US and Canada will impact this spread this fall, but unless there is a one crop is either really impacted by drought and the other isn't, I would expect that the spread probably continues to remain close to this kind of 5-cent area. And the only other thing that I could think of that might move this spread a little bit is if we see a further increase in canola oil usage in biomass-based diesel production. We've seen quite an increase over the last several months following the approval of pathway for RIN generation. And the EIA basically said that canola oil used in biomass-based diesel production in April was 270 million pounds, I think, which was down a little bit from the peak the prior month, but it still is more than double what we saw last year. So if we start to see, 400, 500, 600 million pounds of canola oil being used each month in biomass-based diesel production, then we could start to see the spread widen back out towards the long-term average. However, I don't know that we're going to get to that level, just because canola oil is one of the more expensive, and here it's despite the compression in the spread, it's still 4 cents above soybean oil per pound, so 28 cents more, 32 cents more per gallon of renewable diesel production. Given where margins are for renewable diesel and biodiesel, that starts to get pretty tight. So I don't expect to see a huge increase in biomass-based diesel feedstock demand, but if we did get that, that would be something else that would probably drive us to raise our expectations for this spread. But in general, I don't think that any of that's going to happen. And until we know really a lot more about where we think the crops are going to end up, we're probably going to stay relatively close to this level. And then this is soybean oil futures and palm oil futures. So soybean oil futures minus palm oil for the same contract. And there's this chart's a bit busy. I apologize. There's a couple of different contracts on here, and then the relatively smooth red and blue lines are moving averages. And I think the red is like a 200-day moving average or something like that. And you can see that spread came down and got down to as low as 10 cents in May, but has shot back up and is now, the nearby contract is 30 cents or 31 cents. The January contract, however, is 9 cents. The spread is 9 cents narrower. And one of the things that I think is important in this case is that that difference between the nearby spread and the January spread, because even if the U.S. crop is not all that it's supposed to be, until somebody proves otherwise, the market's going to believe that South America is going to produce significantly more soybeans than they did last year. And so that spread is narrower in part because the market expects a big injection of soybean oil supply around, well, starting in early 2024 as Brazil harvests its first soybeans, or early soybeans anyway. And that really, that same development also drives a lot of our price forecasts. So in the short term, over the next couple of months, the U.S. crop and growing conditions are going to have a big impact on vegetable oil prices, and should help support vegetable oil prices, unless the weather pattern changes again and we go back to, an inch or so of rain across most of the Corn Belt each week. I think that you probably are going to have prices, if not continuing to rally, at least not drop sharply here until we start to really get through, or at least start to get a picture of what early September weather is going to look like in the Corn Belt, and whether we're going to get enough rain to boost soybean yields. If we don't, though, then the South American crop is going to come in and is going to weigh on prices. I think, again, until we kind of start to have the opinion that something is wrong with the South American crop, which there's no reason to expect that that's going to happen. But until we start to have that opinion, I think that most analysts will believe that prices may be supported in the short term, but in the longer term, then they will come under pressure as the large South American crop works its way into the market, and that will also weigh on soybean oil futures. The one difference may be is in basis, and like I said, basis didn't look like it moved at all last week, and its basis is still at the upper end of the historical range for RBD, but it seems like it's kind of flattened out here recently. And if you look at what our model suggests some weakness here over the next month or two, and then as renewable diesel feedstock demand continues to grow, then you get some support out after in early 2024, basically for basis levels. However, given the difference between U.S. prices and prices essentially in the rest of the world, while I don't expect huge imports, I do expect that the opportunity to buy from Argentina at significantly lower prices may limit the upside risk in basis going forward. Because the US market is really disconnected from the world market, changes in world fundamentals have a harder time translating into changes in US cash prices than they do if we're exporting 2 billion pounds of soybean oil, or even if we were importing 2 billion pounds of soybean oil. Then the world price would act as a balancer for the domestic price. But because right now we basically are almost net neutral on trade flows, export 300 million pounds, import 300 million pounds, the difficulty in translating world prices into US prices is evident in all of these spreads. If the world is really short soybean oil, however, then some of that export demand for US soybean oil will probably return. Even if we don't ship anything, just the need for it will support US Gulf basis. And while that doesn't necessarily seem the case if you look at Argentine prices, if that does happen, then that's the one scenario where I could see that basis levels might continue to strengthen and then add on to whatever level they finish this year at in 2024 as feedstock demand grows. There have been, over the last couple of years, there have been several times that I have forecast really big US soybean oil imports, mostly just to show what the gap between the feedstock demand and feedstock supply would be, since we use soybean oil as sort of our marginal feedstock. There was a time that I thought, oh, well, we're going to have to import soybean oil because where are the feedstocks going to come from? And of course, since then, we've increased our UCO imports, and there have been, as sort of there always are in big changes like that, there have been a lot of little answers that have kind of combined to help offset some of the pressure. But this is the first time that I would consider, even though we're not going to, but the first time that other stuff is lining up that might suggest that the US might start to import more soybean oil than we traditionally have. And I don't mean that for 22, 23, and maybe not even 23, 24. But given the trend and in the way that things are going, this historically wide spreads for US soybean oil and vegetable oil in other parts of the world, at some point, Econ 101 is going to kick in, and at some point, the industry is going to start to focus on importing feedstocks. Now, again, it may be that what we see is what I've expected for a while, which is kind of a shift in canola oil into the food industry, palm oil into the feed industry. And so we don't necessarily import a lot more soybean oil, but we increase imports of canola and palm and other stuff like BFT and UCO, which all of that has already started to happen. But given the fact that all of that has already started to happen, and you still get these wide spreads in soybean oil that are ramping back out towards their all-time highs, suggests that the domestic market still is a little short of soybean oil. And again, while that doesn't mean that we're going to change our forecast in the short term, if that's persistent and continues, and the market expects it to continue, then I believe you'll start to see the industry start to shift a little bit. All right, so what does all that mean for biofuel margins? Well, for biodiesel, the news just does not get much better. This week, our estimate of biodiesel margins in the California market dropped another 10 cents to negative 75 cents based on our feedstock mix. That is more heavily soybean oil, 75% soybean oil, 25% yellow grease, compared to our renewable diesel, which is 50% tallow, 25% DCO, and 25% UCO. But the thing here, I think, is so this is just looking at soybean oil profitability across different regions, and the fact that margins are really negative basically everywhere doesn't suggest that we're going to pop right out of this. I don't know that we're going to get down to where we were during the pandemic, but it does feel more and more like this is finally the time when the pressure on biodiesel margins could start to rationalize biodiesel capacity, which is something that people have been waiting for, and I've gotten questions about for the last couple of years. We haven't seen it yet, at least not in the formal EIA data. There have been, I think, maybe one anecdotal report of a biodiesel producer closing. However, on the opposite side, I will say that interest in biodiesel production and the questions that I get from people in the financial industry have been more focused on biodiesel over the last several months than they have over much of the last year. Part of that may just be that over much of the last year, most of those people were focused on renewable diesel and trying to figure out if they could invest in a renewable diesel facility. And now it may be that they have invested in a renewable diesel facility and they are wondering when biodiesel capacity might rationalize a little bit. But based on their questions, that's not necessarily it. It's a little bit more on the investing side. And if margins don't turn around, probably that interest is going to go away too. I still do believe firmly that we aren't quite at the point yet where we are going to significantly reduce biodiesel capacity in the U.S. just based on these margins. And you can see even after the pandemic, or I guess during the pandemic, we were still at about this same level, and then margins recovered and actually shot up to historic highs. So one, biodiesel producers should be in pretty good shape financially from a balance sheet perspective. Hopefully they were able to take advantage of margins over the last year almost to really get kind of the balance sheet in order. And two, it's only been a relatively short period of time. And while margins have fallen substantially and are really, really negative, in theory, we could get a sharp rally in energy prices and all of this will kind of turn around. All of that said, I think what is happening in soybean oil and what's happening with margins here suggests that the feedstock market itself is struggling a little bit with supply. And so we haven't really seen the kind of we haven't seen the kind of pressure that we might see in a couple of months, and the decline has been so sharp and fast that it hasn't really persisted for very long. So it's a shock to the system, but it hasn't really settled in. And so again, I don't know that I necessarily expect to see a lot of rationalization. Maybe if this persists at these levels or lower through the end of the year, we would start to see some. But in the short term, again, I think that we won't necessarily see a lot. Now, that said, in a minute here, I'm going to show you the impact of the decline in margins on biodiesel production and renewable diesel production in June. That's when margins really started to kind of collapse, and it does look like there's some impact there. So if this continues, or if instead of starting June with positive margins and ending June with negative margins, we start July with negative margins and then end July with more negative margins, the July EMTS data probably will be really interesting and probably will reflect more of an impact from margins than the June data does. So this just shows the comparison for profitability in just the California market, but then across feedstocks. And you can see there's actually quite a bit of spread between sort of the veg oils, soybean oil, canola oil, and some of the low CI feedstocks, yellow grease and UCO. However, everything is down from its peak at the end of 2022, and with 3 of the feedstocks already in negative territory, and BFT heading there pretty quickly, it doesn't suggest that we're going to see really strong demand from the biodiesel industry, but there will be some amount of demand, obviously, just based on if your facility is open and you produce biodiesel, you're going to need to keep producing biodiesel. And so maybe it'll be more of a little bit of a switch or a refining of feedstock mixes. But it's the margin does not look as nice as it has for much of the last 2 years, I guess is the best way to say it. So this is renewable diesel across different feedstocks, and you can see here that basically, you can see here that basically everything is still in positive territory or marginally positive, but again, sort of off the highs that we saw in 2021 and 2022, and down towards the lower end of the historical range for almost everything. Soybean oil actually looks a little bit better here. Veg oils actually look a little bit better here than they do for biodiesel. And you can see the average for all the feedstocks is about 8 cents a pound more than it is for biodiesel, for renewable diesel. This doesn't suggest that the build out of renewable diesel capacity is going to accelerate, but it also doesn't suggest that it needs to shut off completely. If you are in the process of building a renewable diesel facility, then I think you look at your margins and you say, okay, those are actually still relatively good for the energy industry. And you look at the margins for biodiesel and you think, okay, well, there probably will be at some point some reduction in capacity there. And so I've got to say, if you're a renewable diesel producer, while again, you're not making as much money as you have in the recent past, you probably still should feel relatively good about things, I would think. I mean, for a lot of these feedstocks, the margin is well above sort of the crack spreads that you see, or the historical highs for the crack spreads that you see in oil. I know that's not a great comparison, but it is still kind of on a per gallon basis. Renewable diesel is significantly more profitable than we see with the traditional fossil fuels. And so to me, that kind of says that while there probably is and should be an impact on production in the coming months, assuming that we stay at these levels, one, it shouldn't be as impactful as we see in biodiesel. And then two, and more importantly for the outlook, is that there's nothing right now that suggests that the development of new renewable diesel facilities is going to significantly slow down in the coming months. And I would expect that it will continue. We, again, could always get the odd announcement that somebody's not going to open up or somebody's going to delay their opening or whatever. But I would expect that a lot of what we've seen over the last couple of years in terms of trends in capacity and interest from the financial industry probably is going to continue, maybe tone down just a little bit because of the tightening of margins. But again, I think if you think about it and think, okay, well, if you really believe that there's going to be a significant reduction in biodiesel capacity, then you look at this and you say, okay, well, this is our short-term pain, and in the longer term, we probably will do better than the margins right now would suggest. So here essentially is the impact. And then this is a little, I know this is a busy chart and it's a little tough to look at. But it does show, because it looks at the average daily production and average daily imports, it does kind of reflect the impact of the decline in margins. And so while you can see that production fell from May to June by about 200,000 gallons a day, so from 5.2 million to just over 5 million, that the impact from, well, if you compare this June with last June, which you can't see on here, unfortunately, average daily production is actually up. So while there is a month over month impact that we can look at and say, oh, there it is, there's the beginning of the slowdown in biodiesel production. If you actually look sort of year over year, there's the same thing doesn't necessarily hold up, because biodiesel margins are essentially, from the beginning of the year, our estimate for biodiesel margins in the California market, which is 15% of the total, but still, just for illustrative purposes, in the California market, biodiesel margins were 75 cents at the beginning of 2023, and now they're negative 75 cents, so down $1.50 over that period. That should have had a really significant impact year over year, even if the impact sort of month over month was kind of smaller. And you can see we don't necessarily, I mean, we've got production down a bit in July, again, because of the continuation of the decline in biodiesel margins. But then we start to come back a little bit. And by the end of the year, now December again is always a little bit of a weird month, but by the end of the year, we're above where we are now, one way or the other. Our outlook for margins doesn't get, significantly better, but it does again kind of support this idea that that biodiesel producers probably aren't about to make that decision to close, at least in the short term. Now, starting in January, in next year's production, we kind of cut into a little bit, and in 2025 even more. I get questions about the size of our cut, and as you can see, it's a really significant cut. And I don't know that I think the cut will be that dramatic. And usually you don't see sort of, from December to January, this huge drop off that then persists throughout the year. But since we forecast in years, we kind of have to do that. And as we get closer to January, I'll modify this so that the decline is not as sharp. But I think that if the margins continue where they are now through the end of the year, that our forecast for 2024 probably won't be adjusted as much as it would be, obviously, if margins start to recover. I wouldn't even say that they necessarily would need to get back to, certainly not to the highs that we saw. If they got back to just their long run average, which is kind of a couple cents basically positive per gallon, then I would think that you probably would see much less of a reduction in 2024 than we're predicting, and this chart would look a lot different. But again, if we get to the end of December and margins are still negative 50 cents, then I'm probably not going to raise this that much, and probably going to just end up kind of taking production out of the back months and adding it to the front months, so that the slope between December 23 and December 24 is something that seems reasonable, instead of just a sharp drop off in January 2024. So this is biodiesel, this is renewable diesel production. And you can see in June, renewable diesel production dropped by 32 million gallons. That's not a huge decline relative to the production. I mean, it's 10% month over month, but it still is almost double what we produced last year. And while I think that in the short term, margins probably aren't going to improve because there still will be concerns about the U.S. crop. In the longer term, especially once we get into the South American growing season, then I think you could see an improvement in margins. And just based on the growth in capacity that we have through the end of the year, we kind of have production rising through the end of the year. I adjusted December, so it wasn't so absolutely crazy compared to the rest of the months. The whole thing might still be a little bit high, but that will depend a lot on what we see in terms of the nearly, I think, billion gallons that we expect to come online through the end of the year. How much of that actually does come online? If it does, then I think that this sort of 100 million gallon a month expansion between now and the end of the year is probably not that unreasonable. If we start to see a slowdown, if margins continue to deteriorate and we start to get announcements suggesting that renewable diesel producers aren't going to proceed with their projects or they're going to delay their projects, then we may need to cut this a little bit. But right now, July might be a little high at 250, given where margins have been, but I'm not uncomfortable with the rest of these. For biodiesel, you can see the drop off was smaller. It was just 11 million gallons, and we're kind of again in the spot where, you know, it's not like renewable diesel where this is 2021, 2022, and 2023. Renewable diesel is just kind of holding still here. The one thing I would say about this, and the obvious point, is if margins remain under pressure and fall further, then obviously we'll probably cut our biodiesel forecast at some point. However, I still do believe this idea that until the industry really convinces biodiesel producers that margins are bad and they're going to stay bad forever, I don't know that we're going to see a lot of reduction in monthly production or in capacity. Now, monthly production, maybe July is 5 or 10 million gallons lower, maybe even a little bit more than that, given how bad margins have been. But again, over the rest of this, I'm relatively comfortable with the rest of these. The one other thing that I would just say, and this is just kind of for me as much as anything else, I suppose, we've talked a lot about the seasonality in production, how renewable diesel doesn't really seem to have the same seasonality as biodiesel. And from this chart, you can see over the last couple of months, if you compare those to January and February, it looks like seasonality is maybe not quite as pronounced as it was traditionally in biodiesel, but it is kind of still there. So even the 177 in December, it doesn't feel super uncomfortable given kind of that general pattern, I suppose. All right, and then I'm going to end with this, my favorite EMTS category, and production there. You can see last month shot up to 54 million gallons in a month, which, if this is a combination of two facilities, one of the facilities, their capacity is 30-ish million gallons a month. And so in May, I was relatively convinced that the other facility had started up. We haven't really seen the proof in that from the import side quite yet, partially because we haven't really looked through it in a lot of detail. But either way, it looks like that second facility or both facilities slowed down a little bit in June. And I show this in part because it's unusual, but also in part because based on the RIN pathways that were approved, one of these is a sustainable aviation fuel producer. And so if we look at the EMTS data, generally what we see is in the SAF category, production is 1 million gallons a month or less. And so if part of this, if even 10% of this is SAF production, then it's multiples of the supply that actually gets reported as SAF under the EMTS program. And so I will probably keep putting this chart up just for that reason, because I think that it does give us maybe a little bit of insight into where SAF production really is. And I'm also curious about this. So I will keep digging, and I'll keep showing this chart and probably annoying you a little bit with it once I really get this figured out and really kind of have a good sense of what this is and how much is SAF and how much isn't SAF. Then we'll spend a little bit of time talking about it, again, mostly because I think that it's important if SAF is going to be one of the significant components of feedstock demand in the coming years. I think it's important to understand where we are now, even if SAF production is relatively low compared to renewable diesel production and biodiesel production. Eventually, it's going to and almost has to exceed both of those almost combined. And so to me, understanding early where all of the little pieces are will help in the long run. All right, that is it for this. And I've got some good questions, which I appreciate as always. How much of the canola LA to SBO Chicago spread is due to location differential, and how much is due to actual canola over SBO preference in the market? For example, canola RBD makes better frying oil than soybean oil, or maybe there are CI arbitrages. Yeah, it's a little tough to make that comparison, certainly because it's two different markets, and unfortunately we just don't have a good consistent source for canola prices in Chicago. It's something that I know the editorial folks are working to try to build back up, not only for canola oil in Chicago, but vegetable oils more broadly. So if you buy or sell vegetable oil, we would love it if you would report some prices to us. That said, the amount of switching that we've seen in the food manufacturing industry from soybean oil to canola there has been some, and if you look at non-biofuel canola use, it's gone up, but it hasn't been as dramatic as this spread would suggest. So I think there probably is a bit of sort of location specific supply and demand fundamentals that are driving that spread, but the spread has been narrow. The narrow spread has persisted for long enough that it does seem to be probably reflective of what's going on more broadly with canola oil and soybean oil. And we do get quotes for Chicago soybean oil or canola oil. And if you look at the difference between Chicago canola and Chicago soybean oil, it's relatively close as well. So it's maybe not quite. I'm trying to think of the last time I saw a quote. I think the last time I saw a quote, I think the prices were either equal or they were very, very close to equal. So I don't disagree that there's some some location specific supply and demand stuff that's going on here that is that's driving part of that. But if you take the location part out of it, and again, it's not quite as great because we don't get the prices as consistently. But just based on sort of the last couple of times that I can remember seeing the prices, that spread is really relatively historically narrow. It seems board crush started its recovery almost to the day of the RVO announcement. What role, if any, did the RVO's perceived impact have in the recovery of the board crush? Boy, that is a really good question. Whoever asked that question has probably been thinking about it for a long time to try and stump me, because that is a good one. So I think that to the extent that that the RVO announcement did have an impact, it would seem like the impact should have been negative, right? So the RVOs came in below market expectations, and so you would think that that wouldn't necessarily support a recovery in board crush. I think that board crush has been helped by at least the early development of the U.S. soybean crop and expectations that that the soybean crop would develop normally, and we would plant all the acres that that farmers said they were going to plant in the prospective plantings. And since then, we've had a cut in acreage and dry and hot weather for some of the summer. And if I look at the continuous board crush, it has been on a tear since almost the day of the announcement. It looks like it's been down for 3 days since sorry to look off here, 3 days in almost the past month. So from June 26th was sort of the recent low, and then it has gone up almost every day since then. I think that part of that may be a little bit of a coincidence. I think that that around that same time, you had the cut in soybean acres come right after that on the 30th, basically, and you had dry weather and forecasts of dry weather through by early July. You had forecasts of dry weather through the middle of July, and the market starting to get concerned about soybeans. Now, that would typically mean that soybean prices would go up, and all else equal, that should depress board crush. But given the movement that we've seen in soybean oil and the persistence of strength in meal prices, I think that the market is probably more worried about the products of crush than crush if we have a short crop this year. And that's because if you think about it, this year in particular, and kind of going forward, it's very easy to cut U.S. soybean exports to make the balance sheets work, and much harder to cut crush. And so because of that sort of extra available supply to crushing that historically would have gone into exports, then the markets for the products are probably a little bit more nervous about whether the decline in soybean production will ultimately impact crush instead of just impacting exports. And on top of that, like I said, I feel like the other part of this is probably that no matter what the RVO said, that the world vegetable oil market feels like it's tightening up a little bit. That may be anecdotal, and it's something that we're working to to figure out so we can talk to you about it and kind of show you what we're thinking about it. But if that is true, then I think that probably has also helped. And then I think the third thing that doesn't contribute to board crush, but crush margin recovery in general, has been the strength of soybean oil basis, especially over the last couple of months, where once we kind of hit that bottom at the end of March or April in there, and started to move back higher, as we've seen the same moves in basis, to where basis is not quite as high as it was last year, but it's close, and much closer than I would have guessed, even after I knew what was going on with the Argentine crop. So I think there's those two parts to it. And then the other part is meal demand remains really strong. So despite the fact that we're in the down part of the cattle cycle and the pig herd has shrunk so much that hog futures are now trading above $1 a pound, the recovery in the poultry flock from last year's avian flu has really helped support meal demand. And if you look at daily average use of meal on a monthly basis, there was a little bit of a slowdown there for a month or two, but the last couple of months have been basically record levels. And I don't remember off the top of my head what the NOPA data implied for June, but I would be really surprised if soybean meal demand dropped off at all. And if you look at soybean meal prices, all of the futures until you get out to May of 2024 are still above $400 a short ton. And that's not the highest level that they've ever been, but it's a relatively high level. And August is at 450. So I think there are a lot of things that are really driving crush right now. And I think that RVOs are probably one of them, but I think that the timing of the recovery in crush margins is maybe a little bit more coincidental. If somebody said you have to come up with a reason to ascribe the movement in crush margins to the release of the RVOs, this is the one thing that I would say, and that is that for the first time in my memory, the biomass-based diesel industry has some certainty about where the mandates are going to be over the next 2 years. So historically, maybe the best we got was kind of we got the mandates in November and for the next year. So the industry had maybe a month or two of kind of pre-planning, I guess, for lack of a better way to say it. And now we've got the mandates out through 2025. And while it's, calculating exactly what production needs to be to meet those mandates is not super straightforward, it still does provide the industry with some certainty that, hey, in a couple of years, we still are going to be producing at these levels, or these levels are still going to be mandated. So if you really wanted to make that argument, that's kind of the way that I would go. I don't know that I think that translates super well into, crush margins going up for 20, I guess, what would it be? It would be about 21 days out of the last 24 or something like that. But I do think that from the industry's perspective, from the biomass-based diesel industry's perspective, I would imagine that having that certainty for the next couple of years is helpful in a lot of ways. So, but that's a really good question. That is a really good question. All right. What is the timing of the South American crop supply? You mentioned January 2024 for Brazil, but meanwhile you see Argentina as the driver. So you still see October 2023 as the start of U.S. soybean oil markets getting ample supply and Chicago SBO prices coming off. Um, there is a lot in that question. So from the timing perspective, the South American harvest season is much longer than the U.S. harvest season, because you start to harvest the earliest soybeans in Brazil probably in January or February, and then you harvest the last soybeans in Argentina in like April or May. And somebody from South America, Joao, probably will tell me later that I'm off on this, but I think that's generally about right, roughly. The early soybeans are generally not a ton of supply, so you really have to get to kind of February, March to really get into the South American crop supply. And even then, I think that is, you know, you probably know before then. You're gonna, I guess what I'm trying to say is, you're gonna have several points sort of along the way where the market will start to factor in more production out of South America. So the crop gets planted, you start to take out some of the weather premium. The crop gets to flowering and is doing fairly well, you take out more weather premium. It's going to rain during pod filling, you take out more weather premium. Because the crop is planted over such a wide range of latitudes, I guess, all of those periods come at slightly different times. And so the South American crop, and sort of saying this is the exact time that the South American crop starts to impact the market in the same way that you would do for the US crop. So for the US crop, I think you say like, oh, okay, October, we're going to have a significant portion of the US crop is going to come in and make its way out into the market. In South America, that window is wider, and so it's a little bit more difficult to kind of say, okay, this is the date. However, I think because everybody really anticipates the increase in production in South America, you probably are going to see pressure earlier than rather than later. And so unless there's a weather problem or planting is delayed or something like that, I assume that if planting goes well in South America, that you will start to see pressure probably by the end of 2023 or in early 2024. Again, just depending on if growing conditions are perfect and the crop goes in really early, then I think you probably will start to see it even earlier. So probably by the end of 2023. If there's some questions about South American production, then it could be, January or February 2024. It's really hard to imagine that South America isn't going to produce a huge crop this year. One of the things I've always said is that it's really hard to get to bet against South American weather. Now, that obviously didn't hold up over the last couple of years, but if you look back over 20 years or something like that, the number of years, and especially years that aren't La Nina years, where South American yields are substantially below trend line, is just, it's not a good way to make money. So what in terms of the timing of when we might see pressure in soybean oil markets, Joao and I were talking about this when we were setting the forecast for palm oil. And I think there are, probably 3 or 4 months of support. And then part of it is you get a better idea of what the US crop is. And so let's just say that the US crop is what we think it is right now, basically. So part of the realization that that's where the crop is going to end up will take some weather premium out of the US market. Weather premium is hung around longer. Typically the US market peaks in June and then kind of takes weather premium out through the rest of the summer. But because it was so dry early in the year, the market actually started to add back in weather premium in June rather than take it out. And so if we get to US harvest and the crop is going to be 52 bushels an acre or whatever you're using as a trend line, then I think that combined with the anticipation for South American production probably will start to pressure soybean oil prices 3 or 4 months from now. So October, November, yep, right in that area. If there's a problem, or it looks like the planning is going to be delayed in South America, that might extend out for another month or two. If conditions are perfect in South America, then that pressure might come just a little bit earlier, although not probably huge pressure from the South American crop itself until we get to November, December, and we really do have a good idea of what we think planning and early season weather is going to be. So this is relating to the crush question. Agreed on what I thought the impact would be. It seems maybe the market was waiting for the announcement to get out of the way to see how bad it was before buying on the underlying supply and demand fundamentals. I wouldn't disagree with that. There certainly is some part of the RVO announcements. I think in particular, I can think back to the last several RVO announcements where you saw the market start to trend after the announcement, either higher or lower, relatively strongly. And that certainty kind of helping people say, okay, there's one unknown that I don't have to deal with anymore. And based on that, the market starts to go in a direction. A lot of times what you'll see for soybean oil, not for crush margins, is a run up into the, and well, you saw it this time too, a run up into the announcement. And then as soon as the announcement comes out, then you see a sell-off. Even in years where the RVOs have been equal to, or I don't think there have been many years where they've been significantly larger than expectations, but even if the RVOs have come in right where everybody expected them to, then you still see a sell-off. So I wouldn't disagree with that. On the RVOs, is the expectation that they will grow further past 2025? There's in general, kind of yes. So there's a couple of things to think about here. One is if you divide the fuel up into kind of biomass-based diesel and SAF, and let's combine those together, those two distinct categories. And if you look at that production, then I think it's reasonable to assume that production, or that mandates or demand continues to go up 2025, 2030, 2035, because replacing fuel on airplanes with batteries is going to be difficult. If you think about it just from the biomass-based diesel perspective, then through 2025, you probably still get some growth. But at some point, there's going to come a spot where battery technology and the trucking and rail and maybe marine industries really start to switch over from liquid fuels to batteries. And when that happens, or I guess when you think that's going to happen, because I can make an argument that it happens in maybe not 2030, but maybe shortly thereafter. But I also can make an argument that that probably doesn't happen until 2050. So whatever your expectation is for that, when you hit that point, then you probably start to get a flattening out in biomass-based diesel demand. But I think there's a big question that how quickly, once we reach that point, whether it kind of just goes flat or it starts to decline. And if you think about it sort of in the same way that you think about ethanol. So ethanol is obviously more focused on gasoline and in passenger vehicles, which have started the transition, I think, a little bit earlier. And what you've seen is ethanol demand go flat and then start to kind of come down a little bit. Now, part of that is also that because people work from home more frequently, just in general, gasoline usage is down. But if you look out to 2030 for ethanol, the volume of ethanol that's going to be required in 2030 is probably lower than it's going to be today, assuming that there isn't some reversal in the federal government's desire to have all cars become electric vehicles, or there isn't some change in consumer preferences or something like that. But because of that, so ethanol probably has seen its high watermark for production and probably starts to tail off kind of slowly. And then depending on what happens, or if the federal government were to say like, okay, everybody's got to buy an electric vehicle now, or the car companies just stopped producing ICE engines, then you would see a little bit more abrupt change. But other than that, I think that will look relatively similar to what we see in biodiesel for, again, the on long haul trucking, rail, and marine. So I don't think that there's a danger that that the demand isn't necessarily going to be there, or the RFS program is going to change and start to lower the RVOs now, in part because when you do that, you make the farmers angry, and nobody really wants to make the farmers angry. And so I think that that the one way that you could see lower RVOs is what we saw when small refinery exemptions grew, and there were people who were applying for those all over. So the elimination of small refinery exemptions has meant that the RVOs are the RVOs. If small refinery exemptions come back in a significant way, that's kind of a way to reduce the RVOs without necessarily reducing the RVOs. And that's the one area where you could see a reduction in the mandates. All right, that is it for this week. The last thing that I want to mention is that we are absolutely going to publish this week. I know that I have told you that probably 10 times over the last several months, and I really appreciate everybody's patience while I've been trying to switch computers for much longer than it ever should have taken me. But yesterday I finally got the one program that I actually needed to do forecasts, price forecasts, and publish price forecasts on my computer and working. And so we are going to publish this week, and then going forward, we will be back on the publishing every week schedule, which hopefully will make all of this better. All right. Thanks again for coming. Thanks for all the great questions this week. And I look forward to seeing everybody next week. Have a great weekend, everybody. Bye-bye.